This is a panel of investors, so I'd like you all to put your investor's hat on and respond, if you would, to this next poll we have. That's the QR code for the polls and the questions. Don't forget about the questions either, but here is the question for this poll. The best investment over the next 5 years will be A, AI, B, emerging markets, C, biotech, or D, Bitcoin. Clearly testing your risk appetite here. So please log into the QR code, participate in the poll as we get this panel discussion underway. I mentioned that we are lucky indeed to have three of the world's most sophisticated investors sitting with me here on stage. Philippe, to my right, oversees $1.5 trillion across the investment landscape. Davide is a specialist in financials whose firm invests in global equity and global credit. And Dilhan runs one of Singapore's esteemed sovereign wealth funds. Gentlemen, from the 2009 financial crisis and through the pandemic until at least 2024, 15 years we're talking about, US financial assets so clearly outperformed the rest of the world that we started talking about American exceptionalism. The notion that US markets are somehow uniquely superior, more resilient, more structurally robust compared with other developed economies. Now, perhaps for obvious reasons, investors everywhere are asking this question: is the era of American exceptionalism over? And it's a perfect question, feels like the perfect question to me to be asking after a brutal 4-day sell-off in US equities. So let's answer it right now. Davide, is the era of American exceptionalism over?
I would say the gap in returns of the last 20 years from GDP to financial markets, in my view, are over. And the reason is that if you think about it, it's 30% of global GDP, but it's 70% of markets, equity and fixed income. It's 70% of private credit and private equity. And never in history, 1/3 of the economy could command 70% of world valuation. And I think as a result, we're peaking. Why we're peaking? Because 20 years ago, the US Treasury had 50% public debt to GDP. Right now it's 130, going to have 150. And hence, the actual currency that is backing all this, it's at its limit of what can print. And so to me, when you have a third of economy and it's worth 70% of global markets, you're close to the mathematical limits of what you can be. Does not mean the returns will keep on being high. But in percentage terms, I think mathematically you're the limit.
Who wants to take this on?
Let's say my first remark is I do share your point. Clearly, we are, let's say, I don't know if we are the limit, close to the limit, but the overperformance of US assets, but I would say financial markets as a whole, but US, of course, in particular, during the last 15 years is just amazing, comparing with the value creation of the economy. My second remark is I have been for 35 years in this portfolio management, asset management industry, and I have to say that every year, almost every year, for 35 years, I have this question: is let's say, are the US markets going to underperform the rest of the world, Europe, Asia, blah, blah, blah? Always the same story. My only remark on that is I think it would be better for any financial market in the world that US economy and US financial markets go well and continue to go well. Second remark is based on what you said. I think if we observed and we lived in this decoupling between economy and performance of the financial assets, this is clearly not due to, let's say, this is of course part due to the innovation, productivity, blah, 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 but this is mainly due to the interest rates environment. After the financial crisis in 2008, 2009, the quantitative easing, which has been implemented and executed by all the central banks, and in particular with the Fed, which is the central bank of the world. We like it, we do not like it. This is a fact. This is the central bank of the world. And it has been just incredible. And the financial markets flew thanks to this quantitative easing performed everywhere in the world, and in particular in the US. And just my last remark on that, it seems because of inflation, because of, let's say, maybe also because of the first month of the second run of the President Trump, this period is maybe over. This period of zero interest rates around the world is over. And it changed dramatically the way of making investment in the future.
Dilhan.
So Erik, I think it's a question of how we define US exceptionalism. You can define it by reference to financial markets or more broadly as to what allows the US to perform well in the financial markets. I think there are 5 factors that go into US exceptionalism. The first is the breadth and depth of the capital markets, okay, which is very significant. I would say US exceptionalism in capital markets remains where it is today. 65% of equity is US dollar denominated stocks. You've got 60% foreign currency debt is US dollar denominated, and then forex flows 88%. So a lot of it is driven also by capital markets as well. So that's one level to look at. The second is innovation. US exceptionalism also drives on the back of innovation, and that's science. That's the universities they have, that's ability to attract talent to come in, all of which right now may be under a little bit of stress, no doubt. The third is US military power, which gives them that sort of hegemonic ability to push itself beyond its boundaries. The fourth, I would say, is institutions in the US and the rule of law, which also is coming under a little bit of stress right now. And the fifth, of course, is the reserve currency, which now accounts for about 58% of central bank reserves and is used for transactional flows almost everywhere. So when you look at these 5 factors, US exceptionalism for the time being doesn't look as though it's going to be at risk. But for all of these 5 factors, you do have things that could cause a little bit of fraying, and that could cause US exceptionalism to be at risk if you think over the longer term.
So you're defining US exceptionalism or American exceptionalism in more comprehensively, I would say.
Because all of these things contribute towards why we gravitate our capital flows into the United States, right? At the end of the day, right? The dollar, the US being a hegemonic power, to some extent. You've got to think about world of technopolarity, right now, US technology companies.
I would summarize your remarks by saying, and you tell me if I'm wrong, that no, the era of American exceptionalism is not over.
Not for the time being.
Not for the time being.
But the one thing we have to bear in mind, a lot of it is also due to foreign flows into the United States. If you think about technopolarity and the funding. So 40% of equities comes from outside the US. 40% of equities in the US flows come from outside the US. Half of them come from Europe. And the next one after is Canada, then you've got Japan, Korea, and so on. You've got that going for yourself. 31% of US treasuries are funded from outside the US. These are significant flows that allow you to continue to maintain significant exceptionalism in private markets and public markets. It goes towards funding this phenomenal innovation that we're seeing that allows you, therefore, to assert yourself over the area of technological contestation that's going on right now in the global markets or global arena.
Folks, we put the polling question to you a few minutes ago. How about we bring up the results? Because I think they will help very elegantly lead into my next question. The question was best investment over the next 5 years. AI, emerging markets, biotech, Bitcoin. Wow, look at that. A lot of dispersion in those results.
Suspect you have a younger group of people, you might have a different.
This is true.
By emerging market, do you mean any market outside of the US?
So with this as a backdrop, Dilhan, you're someone who looks at investing on a multi-generational time horizon. That is what Temasek was born to do back in, 1974?
Yeah.
So what do you believe will be the most durable source of cash flows and sustained outperformance over time? Is it one of these? Is it AI? Is it something else?
No, I think at the end of the day, the most important thing for us is how to build a resilient and forward-looking portfolio, right? Resilient. So you've got to take the view that there'll be many shocks happening in the world. We've just been through a massive one this year, and you've got to figure out whether your portfolio of companies can withstand and come back, bounce forward, if you want to put it that way. And then forward-looking means you've got to look at where the big shifts are happening. So technology is a big shift. Climate, by the way, is a big shift. Okay, it's still there. It's still relevant no matter where it is on the polling in the earlier session. And by the way, AI is going to have a real impact on climate solutions. So if you look at AI, that's the biggest change that we face today. It's going to affect
the energy demand.
Energy demand is the biggest bugbear we face today with regard to AI, but AI is there. It's gonna affect all businesses. Energy is the biggest issue to making it a reality. So abundance of energy is required because of the demand, and technology solutions are not there to significantly impact the use of energy in the context of compute power for the time being. So that becomes a risk. In terms of funding of AI models, if you think about it from that perspective, you can argue that the amount of capital that's going into infrastructure for AI or enabling AI is a lot more than what's required right now, but it may be not, because it depends on demand, right? So the question is whether it's going to become a reality, and that depends on other factors, of which energy is one. And the other, of course, is whether you're going to see the kind of effects that you think are going to come about from the race for AI superiority today. So you've got two countries looking at this primarily. You've got the US, you've got China. Okay, the race is not over yet. In compute power, the US is ahead. In energy, China is ahead. In product services application layer, the US is ahead. In adoption, China is ahead. So where this turns out is a big question for all of us.
You're making this so hard for me. I'm looking for simple answers that my audience
I wish I
take
had
to the bank.
Answers. I have more questions than answers, I guess.
What do you gentlemen think?
Take it.
I mean, maybe I should phrase it this way. So clearly, the story of, I think AI is clearly part of the mix here. The story of US equity outperformance in recent years, certainly over the past 3 years, is really a story of 7 stocks, right? The Mag 7, Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and of course, Tesla. As a result, today, anybody who puts $100 into the S&P 500 is actually getting $35 of the Mag 7 and $65 of the other 493 stocks, which is extraordinary concentration. If you want exposure to AI, how do you reconcile that with the unprecedented level of concentration risk in those stocks?
Very much important question. And link also to what we just said and what I was developing because of the let's say interest rates policy and supporting this index performance during the last 15 years. If you want to be exposed to AI or any other thematic, can be I don't know if AI will be the right let's say bet for the next 5 years. Who knows? What is key is because of this. According to me, because of this normalization of interest rates, in which we just jumped in, I think it will be absolutely crucial for any investor in the world to pick up the right thematic maybe, but also the right players and the right corporates for, let's say, delivering the right level of performance. What I mean by that is I'm not sure that after 15 years of incredible performance of passive investments, which was fine, no problem with that, which was fine, but so much supported by the monetary policy. I think for being able to perform during the next 5 years or the next decade in this normalization, it will be key to be able to pick up the right, with the active choice, the right corporate and the right vehicle for making the investment. This is absolutely crucial for the next future. We are now in an environment which has nothing to do, or which will have nothing to do with the past.
I think today we are at the inflection point from the monetary system, meaning never in history we had global GDP, public debt, 100%. Never happened. Secondly, we never had the reserve currency with 7% deficit. At time of peace, full employment, a market all-time high. 7% deficit in the US or in whoever was a reserve currency, England back in the 1900s, France in the 1800s, only through wars or pandemic. So my view is right now the safest way is, as was said before, protect yourself from governments that are likely to engage in quantitative easing, cheat on inflation numbers, and basically debase your fiat paper, and hence you need to own gold. I was born in 1971. Central banks had 50% of reserves in gold. Today it's 25. But central bank, for the first time today, own more gold than US Treasury. Secondly, China just issued US Treasury in Europe, flat to US Treasury and German Bund, and they had 40 times more demand. Secondly, I just run numbers. AI valuation today require 2 trillion revenue in 2030.
Yeah.
The sum of the revenues of the Mag 7 ex Tesla, it's lower than that. So that means someone is telling me that by 2030, we're going to find another Mag 6. Good luck, I tell you. You can keep your money there, certainly not mine. And third, the big risk, as Mark Rowan has said, of over-engineering passive investing means has now become a function of money printing. Basically, as governments print money and people receive checks, it all goes into passive, it goes into 7 stocks, and that, in my view, will have perverse ramification on the economic development. I think as a result today, a smart allocation is to reduce exposure to this Mag 7. Secondly, increase allocation to the rest of the world on a GDP basis. Why? Because if we're not going to find 2 trillion of revenue to justify the AI revolution, which I think is impossible by 2030, given the level of public debt around the world and where taxes need to go to pay for this debt, the likelihood is we're going to have a significant correction.
Now,
can I just?
Please.
I think we have to make a decision with public markets and private markets also, okay? Because the private markets generates a lot more capital today to support business activity and so on. So I tend to agree that if you look at the public markets, there are risks there for sure. You know, we can call it valuation bubble, et cetera, for sure. The questions, of course, when you talk about US exceptionalism, you talk about time frames. You know, we've seen markets go down in the US for the last 15 years as well. You know, we have, but it's been able to come back because of the gravitational pull of the US capital markets. I think the 2 issues we have to think about which will impact this story. Number one is the effect of AI on job displacement and societal resilience, because the effect of that would be some political response, you know, depending on the countries and so on, because at the end of the day, lives and livelihoods matter more than the stock market price of the Mag 6. Okay. The second, though, is actually the US dollar becoming weaker, which has already become the case this year. So I would say that, you know, I'll just give you one statistic. Between 2002 and 2012, if you were Singaporean and invested in US stocks, the S&P went up 30%. And the US dollar depreciated against the Sing dollar by 33%. So you have been minus 15% in your returns, okay? Just that, okay? Today, if I look at what's happened with US dollar since March, since April 1st at least, it has depreciated against many currencies. The euro is one, the Sing dollar is the other. And I've now been forced to hedge the US dollar, okay? And the cost of hedging has now gone up because I find everybody's hedging. Canadians are hedging, the Europeans are hedging, etc. It's come to a point now where the cost of my hedges are becoming too much, that I have to therefore think about a natural hedge. So what's a natural hedge? It means I've got to be looking for things that give me on a net basis the return I expect for the risk associated. So some US dollar denominated assets will not give me a net return that will justify my allocation of capital there. So weakness of US dollar to a non-US dollar denominated investor is a big issue. And that, I think, will have an impact in the capital markets, both public and private.
And if you look at the net financials position, US has 30 trillion of foreign capital, 20 in the equity market, 10 trillion in the US market. Europe has a net financial position plus 5, means Europeans have invested more elsewhere. China plus 8, 10. also because of the closed capital account. I mean, they can't get out. And the Japan +5. So there's a +20 and a -30. Now, this has worked because so far the rate of return in the States has always been higher. But we're now getting to a point where valuation are all-time high. We have, of these Mag 6, few of them ever did real CapEx plan. They made gazillions of cash flow monetizing data. Amazon received less than $2 billion of equity, yeah? And now this company, on a combined basis, they are deploying more than $400 billion per year of CapEx. There's an accounting trick. They're buying computers, chips, and they're amortizing them over 10 years. Now, I don't know you, but last time, every 5 years, I take all my computer and I send them to Africa to my charity. And now they're telling me that this is the most powerful computer in the world, and they amortize them on 10 years, and you think that's real earnings? And that's an accounting trick. You know, I was trained to these guys. And hence, in my view, when you look at the EPS growth for some in Mag 7, in reality, it's non-cash. They spend the money on computers, the revenue are not there yet, maybe inshallah, but the numbers is so high that the probability that this won't happen is high. My last point on AI, you know, today on any OpenAI tool, for a basic, let's say, you know, what's the weather today or what 4+4 does, our brain uses 220 million less energy than AI. Now, I'm not a scientist, but climate change is real. I climb and I dive. I can tell you if you're on the Alps, glaciers are falling. And the idea that now we're going to have billions of people asking stupid questions and burning 220 times more energy, yeah? And you think that that's an investment? I mean, good luck to you. You're going to have your money, not mine. Now, and hence, I think the last point. I spoke to two of the brightest venture capitalists in America. They're selling anything. Why? Because I said no one knows if this is true. Secondly, no one knows when. Third, the level of capital expenditure today, only governments can back it. And I find it hilarious that OpenAI now wants to be government bailed out on its CapEx. So hang on a second. So why should the US taxpayer give guarantee on its CapEx and profits to private shareholder? I mean, I understand the world is funny, but come on.
So nobody wants to say that the era of American exceptionalism is over, but you're all kind of making a bearish case for U.S. markets and the U.S. economy.
But you can diversify your portfolio everywhere else in the
Okay,
US.
so let's talk about that. Where else do you go?
Sorry, it's called valuation. Palantir is 123 times revenue. It's an amazing company.
Yes.
123 times revenue? Man.
And you have 493 US companies, which are very much interesting as well. Huh? So you can diversify your portfolio, including in the US. But we are also over region. You spoke this morning about Japan and the reform in Japan. And we spoke a bit about Europe. Europe is, I'm not sure that Europe is, let's say, the new heaven for the next decade, but for sure it will change.
Well, valuations are lower.
Yes, but
that's for sure.
Hopefully, yes. But there is clearly a rationale behind that. But for example, in Europe, for the first time in 20, 30, 40 years, maybe 50 years, for the first time, there is an alignment in EU, let's say, for strengthening the, let's say, economic competitiveness of the EU. This is the first time, because for 40 years, 50 years in the EU, we are focused on regulation for protecting the customer. This is the only target and the only focus of the EU. Now, it's new. They also think that it could be helpful to think about the production and to think about the corporate and to strengthen this environment. Fine. There are a lot of proposals. We make a lot of proposals. I don't know if I'm not sure that it will, for sure it will take time, but this will to develop the EU economy is also maybe due to the wake-up call of beginning of this year, but clearly this is promising. I hope we will have time.
In theory.
In theory, exactly. In theory. For a year, we speak about simplification of regulation in Europe. For example, for the moment, I still wait for any simplification. So this is in theory. Now we have to implement and to execute.
One last question to put to all three of you while we still have time. I'd like to try and tie what we've been talking about here together with the overarching theme of this forum. Economically, the world over the course of this year, and I think arguably this predates the re-arrival, let's say, of Donald Trump to the White House, the world has been pivoting from efficiency to security. It's the story in trade, it's the story in manufacturing, and increasingly it's the story in technology. Should it apply to investing as well? Does it make sense to buy assets that are secure and resilient, even if they're structurally less attractive? Do you bake in a geopolitical discount?
I think you have the answer in your question. No, but clearly, if there are, let's say, structural changes in the way of approaching the global trade, you have to take them into account in your portfolio construction, no doubt. Otherwise,
it's part of your macro overlay.
Absolutely, absolutely. If you continue to build a portfolio, let's say, to invest based on what was your habit and your approach during the last 15 years, I'm sure, I have no doubt that we will all be wrong, no doubt. So you have to adapt your portfolio, and yes, maybe we develop this concept of local for local. Maybe, yes, but for sure we have to take it into account, no doubt. EU, Japan, Asia, yes.
Dilhan, how do you factor geopolitics into your investment strategy?
Look, we've been doing this now for 8 years, 7 years. And so everything we look at now, we look at with a geopolitical lens, even more so in the last, I would say, couple of years. And it's not just about the contestation between the US and China. That's obviously the big one there. But you have to think about whether we're going really into a multipolar world, okay, what some people might call the great rebalancing. And in which case, you take the view that between the two big powers, you have a bunch of middle powers who are going to be asserting for influence. Regional influence for sure, but perhaps even global influence between the two superpowers. And then if you look at it from that perspective, then your allocation of capital becomes more complex as to where you're going to put the money to work, because you have to look at second, third order effects for that. And then you've got to figure out what does that mean for your cost of capital, because your risk and reward has to be on a risk-adjusted basis, right? So that's a fundamental issue. And macro issues become relevant. Currency is one. Geopolitical risk feed into that issue as well. Trade balances, fiscal balances, all that will come in. The question that I think we grapple with, where do we rotate our capital into? Okay, so you have two choices, geographical and asset classes, right? So geographical, which market can absorb that rotation of capital away from the United States? Private capital and public capital. Now, private is a little bit different because you've got illiquidity in there, but public markets is the other issue. Number of public market companies in the US has halved in the last 20 years, right? So even then, the choices in the US is one thing, but choices outside the US is even worse to some extent in terms of volume, your investable space. And then if you look at the promising markets, in terms of equity performance the last 2 to 3 years, you look at India, you look at China, look at Europe in the last 12 months or so, the absorption capacity is not there for rotation out in significant levels. Then you look at alternative asset classes. Private credit, well, people talk about it being risky, but it's less risky than being in equity in a cap stack, right? So it depends on how you play the private credit market. You can look at fixed income. We're not a fixed income investor, but that's one way to go into it because now interest rates are not zero, so actually you're getting paid for cash. You can go to commodities, etc. We're not a commodities investor, but that's what people will be looking at as a diversifier. But you can look at infrastructure, which to me is uncorrelated to our equities returns, and I'll look at that because if you go into the right spaces, core plus infrastructure, for example, you get yield and a total return, and it's a balancing thing. But the fact is that for all these alternative asset classes, it's all denominated in US dollars. right? So the rotation that you have to think about is very complex, which is why I debate the question as to whether, by the way, there's no American on our panel, but I debate the question as to whether US exceptionalism is coming to an end soon. Now, it might be that the structural issues we face in the United States are issues that have to be thought about in your risk analysis. But the rotation is not easy. And that's the reality.
Davide, quickly, last word to you.
Yeah, I think just stop on the 32nd floor of a GIC building and see how it was created. In 1974, the finance minister,
981.
running the central bank reserve back then, sold all its US Treasury and bought gold. And that's how GIC was created. And so in my view, only 3 times over the last 150 years, the dollar tried to debase. When it did, it lost 35%. And then basically you had a massive geopolitical accord to put a floor. This time, I doubt we'll have one. But most importantly, it's coming at a time where never again in history over the last 500 years, we had public debt equal 1 times GDP.
Yeah.
That means all your fiat paper, doesn't matter which one, is bad. And hence, to me, this fake illusion that returns keep on being nominal will be the biggest wake-up call. That's why the smart investor called what is called the Turkish portfolio, physical assets, including all type of commodities, because you can't print them. You can't print water, you can't print timber, you can't print infrastructure, you can't print gold, you can't print platinum, copper, yeah? You need to find it. And at the same time, ultra high quality equity. Now the issue is, are you happy to put 25% of all your saving in 5 years company, which are amortizing computing at 10 years, when your normal computer amortizing 3? I'm not.
Ladies and gentlemen, please join me in thanking our panelists, Dilhan Pillay, Davide Serra, Philippe Setbon.
Thank you.